Good morning, everybody. Thank you, Chris Downey, and congratulations on your 100-year anniversary. My organization, the Tax Foundation, is just a mere young 85 years old this year, so I congratulate you on outliving us, so to speak.
You youngsters.
Good morning, everyone. There are many ways that governments can undermine liberty and free enterprise. There's political oppression, which we see everywhere around us. There's regulatory policy, and of course, there's tax policy. And we should be especially troubled, I think, in today's world by the kinds of progressive and redistributive tax policies that are in vogue in many places today. Wealth taxes, digital services taxes, financial transactions taxes, and now, of course, talk of a global minimum tax on corporations. Progressive tax policies limit opportunities. They reduce incentives to work. They undermine entrepreneurship. They lower living standards. They are anti-economic growth. The left uses tax policies to punish success and wealth creation in the same way that they use taxes to punish sinful behavior like smoking or drinking or gambling. But good tax policies can liberate people and unleash economies to reach their full potential. And we can all become advocates for pro-growth tax policy by understanding a few core principles and a little bit of tax economics. Let's start with first principles. My organization, the Tax Foundation in the United States, is guided by four simple principles of sound tax policy: neutrality, simplicity, stability, and transparency. Now, what do these mean? Neutrality means that taxes should not be used to micromanage the economy, subsidize some behaviors, and punish others. So things like tax credits for electric vehicles, that would be non-neutral. Zero rating certain products for VAT, that's non-neutral. That distorts the marketplace. Simplicity, well, that's pretty easy, I think, to understand. Taxes should be easy to administer for governments, but also easy for us to comply with. Stability means that taxes should not change very often. We should be able to predict our own economic and business behavior based on a stable tax system. And transparency means that we should know what we're paying taxes for and where they are going. A number of years ago, I was here in Europe, and I think I was meeting in the UK, a very senior official at Inland Revenue. And he said the VAT is the perfect tool for funding big government because it is hidden from view and you can always dial up the rate if you need more revenues. I thought that was pretty profound. Well, with those four principles in mind, let's look at the economics of tax policy. Many years ago, economists at the OECD developed what we called a hierarchy of tax harm. And this is a very simple way of, I think, communicating why some taxes are more harmful than others, and why governments should change the mix of their tax policies based on the economics. The corporate tax is found to be the most harmful tax for economic growth. And why? It's because capital is the most mobile factor in the economy and thus the most sensitive to high tax rates. Personal income taxes were found to be the second most harmful tax for economic growth. Why? Well, we're pretty mobile, especially here in Europe. You can change countries in a day. In the United States, of course, we can move from state to state. And of course, we can also change the amount of work that we do based on high tax rates. The third most harmful tax were consumption taxes. Pretty standard there. We don't have a lot of choices in the kind of consumption that we have to make. And then property taxes, at least hard property or solid land especially, is found to be the least harmful tax, and that's because, well, land is immobile. But these are all relative and not absolute. Well, this hierarchy tells us that governments should, one, lean more heavily on taxing consumption over income. We should not double tax savings and investment. We should tax businesses at a low rate, if at all, on a cash flow basis. And taxes should be levied on a broad base with low rates. So, how can we use these principles and this economics to assess tax policy in our countries? Well, just so happens, every year my organization, the Tax Foundation, publishes our International Tax Competitiveness Index. And this ranks the quality of the tax systems of the 37 OECD countries. And the index is comprised of more than 40 different components, covering corporate income taxes, personal income taxes, consumption taxes, property taxes, and a compliance burden element. And it's essentially a measure of the structure of a country's tax system, not how much it taxes, but the actual structure of it itself. And the most important principle of this index is neutrality. So here are the top 5 ranking countries with the most competitive tax systems. Number 1, Estonia. Second, Latvia. Third, New Zealand. Fourth, Switzerland. And 5, Luxembourg. Now, generally speaking, these top ranking countries tend to have systems with broad bases, low rates. Their systems have few carve-outs and preferences. The international tax rules make them a welcome place for business investment. Now, why does Estonia rank number 1? Well, in the 8 years that we've been doing this index, Estonia has been number 1 every year. And so we're national heroes in Estonia. I was welcomed there with warm arms a couple years ago when I gave a speech there. Well, first, Estonia has a 20% tax rate on corporate income that's applied only to distributed profits. So if you're in business, you can continue to reinvest your profits back in the business, and the only time that you pay tax is when you pay that out to shareholders. And those taxes, or those dividends, are not taxed at the individual level. And Estonia has a 20% tax on individual income, but it doesn't tax corporate taxes twice, or income twice. Third is property taxes apply only to the value of land rather than the value of the building on top of it. And finally, Estonia has a territorial tax system so that it's only taxing domestic profits. It's not taxing the profits, the international profits of its businesses. Now let's look at the 5 worst ranking countries. And these are the countries with the least competitive tax systems, starting with Italy, with the least competitive or worst tax system in the OECD, followed by our friends from Poland, sadly, France, which we all think is the worst, but apparently it's third worst, Portugal, and Mexico. Now, these countries tend to levy higher than average corporate tax rates, except for Poland, which has a 19% rate. Good for them. And then they have typically higher consumption taxes like VAT. Mexico is the outlier there with a 16% VAT. The rest have very high ones. Now, Italy has a wealth tax on financial assets, real estate tax, financial transactions tax, and an inheritance tax. It has a high compliance burden, and its value-added tax covers less than 40% of all consumption in the country, which obviously means there's a lot of avoidance, fraud, and whatnot. So there you have it. There you have it. Those are the key principles for pro-growth tax policy. They start with the 4 basic principles: neutrality, simplicity, stability, and transparency, with neutrality being number 1. Understanding the hierarchy of tax harm, recognizing that taxes on income are the most harmful taxes for economic growth, with the corporate tax being the most harmful. And finally, we should encourage all of our countries to have tax systems more like Estonia and less like Italy. So now you're all armed to be evangelists for pro-growth tax policy. So go out and conquer. Thank you.
Can you send it to us?